Tina koutou kia koutou, ko te ronga toko manga, ko te ronga toko awa, ko John Small aho. Good morning everyone, and thank you for joining us today. I'm John Small, Chair of the Commerce Commission, and it's great to have so many of you with us today on this call. In a moment, I'm going to take you through our findings from our competition study into personal banking services, along with the recommendations that we think will help drive competition in the sector. And then I'll open the floor to media on the call to ask questions. But I just want to start by acknowledging everyone who's contributed to the study. I want to extend a particular thanks to the bank chief executives and senior leadership teams and those in the wider sector who have shared their time, their views and their experiences with us. We've also appreciated the engagement from other interested parties, particularly fintechs and consumers. We have read and absorbed everything that's been shared with us, and it's helped to inform what I'll be sharing with you today, both our assessment on how competition is currently working and the recommendations. I also want to thank the Commission's Market Studies team of lawyers, economists, skilled investigators, analysts, and my fellow commissioners who have all facilitated this really immense piece of work. So let me just briefly recap how we got here. This sector is obviously hugely important to New Zealanders and the broader economy. Pretty much every household in New Zealand has a bank account and a debit card, and nearly 60% have a credit card. And the residential mortgage market is about $350 billion in overall lending. This is the first study to assess how competition is working in personal banking services in New Zealand, and to ask how competition and the competitive process could be improved. Over the course of the last 14 months, we've refined the scope of the study to focus on deposit accounts and home loans. Our draft report in March this year set out our preliminary findings and draft recommendations, and then further consultation, including at our conference, has helped us to test these and further refine our thinking. Consultation has been really broad. From targeted requests we've obtained and reviewed thousands of documents backed by the availability of our statutory powers. We've also conducted interviews and meetings with banks, the major banks, other banks, non-bank deposit takers, and fintechs. We commissioned some econometric analysis on bank efficiency, and we surveyed over 2,000 Kiwi consumers. Equally important has been wider engagement with customers, consumer groups, iwi Māori, fintechs, domestic and overseas regulators of banking services, and other interested parties through feedback, workshops, and our consultation conference. All of this has given us a good understanding of how the market is working for existing providers, customers, and also those who are seeking to enter this market to help drive innovation. Let me just touch on some of the wider context and themes that are relevant here. You'll know that accelerating open banking is something that our draft report recommended, and there are a couple of strands of Commission work that are relevant to this, which are also hitting significant milestones today. The first is a designation of the Interbank Payment Network. Today, we published our recommendation to the Minister of Commerce and Consumer Affairs to designate the Interbank Payment Network under the Retail Payment Systems Act. Delivery and adoption of new payment options on this network is essential to the success of open banking. Designation of the network will allow us to use our tools to actively drive competition and innovation in the retail payment system and enable the development of new, safe, low-cost and accessible open banking payment solutions. The second is the Payments New Zealand authorisation to negotiate an accreditation and partnering framework, which we've also announced today and that we've approved with conditions. This authorisation allows the joint negotiation of an accreditation framework and standard terms and conditions for partnering between banks and fintechs for the use of APIs for payments. It's also an important part of getting us to open banking in an efficient way. There are also some wider initiatives that are relevant here. The Customer and Product Data Bill, which recently had its first reading in Parliament and will introduce a regulatory framework for an economy-wide consumer data right, and within that, open banking. It's really vital now that work on open banking doesn't stall until the CPD bill has been passed into law and the associated regulations and standards for the banking sector designation under it are in place. So this is an important part of the apparatus that we need for open banking, but we are concerned to make sure that progress doesn't stall on the way to that. We see the implementation of the Deposit Takers Act by the Reserve Bank as an opportunity to better strike an appropriate balance between financial stability and competition. And also, of course, the forthcoming Select Committee inquiry into banking competition, the terms of reference for which were released last week. We see this as complementary to the work we've done here, and we look forward to engaging with the Select Committee in that process. Okay, so let's get into the detail. We presented our draft findings and recommendations in March, and I've mentioned we've consulted extensively since then. The main takeaway is that none of that consultation has changed our thinking on the competitive dynamics in personal banking services. We still see this as a stable two-tier oligopoly with no disruptive maverick and sporadic price competition. On profitability, further work has given us a higher degree of confidence in our finding that profitability across the banking sector in New Zealand at a whole of bank level is high by international standards. Since the draft report, we've looked at this in several different ways, including a close examination of expert work submitted by ANZ. We find that profitability in the banking sector in New Zealand is high by international standards and higher than we would expect if there was more effective competition. Thirdly, regulation is still a constraint. If regulatory barriers to entry and expansion stay high, then there's a risk that even with open banking, the major banks will further consolidate their market positions. Looking ahead, we see the best longer-term and shorter-term prospects for disruptive competition are fintechs and Kiwibank. That's because the smaller domestic banks and non-bank deposit takers in the market today don't have the scale to really take on the major banks. They are similarly structured, they've got similar but higher costs, and have some of their own issues with legacy systems and branch costs, and are well down the batting order for procuring expertise with systems transformation. But they are, particularly the NBDTs, the non-bank deposit takers, important to the communities and consumers that they serve. Disruptive competition increasingly is going to have to come from non-traditional banks, alternative business models, lower costs with new tech stacks, digital propositions. Fintechs offering some, but perhaps not all, of the services of traditional banks. This sector needs open banking as soon as possible. And of course, if Kiwibank were able to grow quickly, it would also disrupt the current equilibrium while that growth was occurring. Improving competition requires multifaceted solutions. Overseas experience suggests that the scale and brand advantages of large banks and consumer inertia are difficult to overcome, even where open banking is well established. Our recommendations are designed to work together to support new entry and expansion, reduce the regulatory barriers to competition, and empower consumers to get better prices and services. As I've signalled, in the shorter term, we see capitalising Kiwibank as having the greatest potential to constrain the major banks and disrupt a market that's otherwise stable due to lack of competition. However, in the medium to longer term, open banking has the greatest potential to promote ongoing disruptive competition for personal banking services. Commitment to ambitious milestones and coordinated work between industry and government, particularly over the next 12 months, can help to accelerate progress and bring early gains to consumers. A number of stakeholders at our conference called for a coordinated plan with milestone dates and regulatory involvement. That means industry and the government need to commit to ensuring open banking is fully operational by June 2026 and set up to continue to evolve and improve from there. Alongside this, the government will need to support open banking by being an early adopter, taking an all-of-government approach to adopting open banking-enabled payments functionality. For example, by supporting new payments for taxes and welfare and government services such as vehicle licensing. This will help build confidence in open banking and assist in developing a market for open banking-enabled products and services. On the regulatory side, if we want a competitive sector, we need a regulatory environment that better supports competition, and we're making a number of recommendations here. Firstly, we're asking the Reserve Bank to broaden the way it undertakes competition assessments under the Deposit Takers Act, placing more focus on reducing barriers to entry and expansion in the banking sector. There is scope for the Reserve Bank to do this within its statutory framework while striking a balance between financial stability and competition. We also point to several specific upcoming decisions where the Reserve Bank has an opportunity to place greater emphasis on competition. These include implementing a more granular standardised risk weighting for home loans and considering the merits of standardised risk weights specifically for lending for housing on Māori freehold land, setting minimum capital standards that encourage fintech competition and permit more entities to call themselves a bank and to provide banking services. Widening the access to exchange settlement accounts is a crucial factor for driving competition in this sector. We're also recommending reducing the risk rating of lending to housing cooperatives and to community housing, and considering a flat rate levy for the depositor compensation scheme, at least initially. Next in this grouping, the government should ensure that existing legislation and future decisions do not unintentionally favour banks, particularly larger banks, over other providers. Government should review existing legislation that favours some providers, such as registered banks, over others, particularly when prescribing where deposits must be held. And we're asking the government to ensure that future decisions are competitively neutral, even when made under urgency, such as in a national emergency. We recommend the government should reduce barriers to switching home loan providers as part of its Credit Contracts and Consumer Finance Act reforms. The Responsible Lending Code should set out guidance making it easier for consumers to switch to lenders who offer better terms. And finally, in this grouping, we want the government to prioritise competition concerns when it reforms the anti-money laundering and counter-financing of terrorism regime. Reforms to this regime are already being looked into, and they should identify and prioritise opportunities to promote competition and access to personal banking services and financial inclusion. The third set of recommendations is about empowering consumers. We've seen a significant degree of consumer inertia when it comes to switching or shopping around. That's not something that's easily solved, but these recommendations are designed to make things easier, empowering consumers to make better informed decisions about their own services. The first is industry investment in the switching service that's already operated by Payments New Zealand, the bank-owned entity. This service needs improvement, starting with greater promotion of the service by the banks and monitoring and reporting on service standards. We want home loan providers to present offers in a readily comparable way, particularly when it comes to cash contributions that are often provided when somebody takes out a loan. The industry needs to create a standardised means of comparing home loan offers across all providers such as through a single effective interest rate that incorporates the effect of cash contributions over the clawback period to help consumers properly compare the cost of different loan offers. Thirdly, we want all clawbacks for mortgage advisor commissions and bank cashback contributions to be prorated over the period that they apply for. Some of these practices impose unjustifiable costs on consumers when they're looking to switch lenders. Next, mortgage advisors and banks need to make changes to promote price competition and choice for home loans. Bank processes need to improve to make it easier for mortgage advisors to submit multiple applications on behalf of their clients. Banks should stop using conversion targets for mortgage advisors and start enabling them to secure several quotes for their clients. Mortgage advisors need to highlight gaps in their lender panels, identify to their clients any superior headline rates that may be available from off-panel providers, and where possible, present at least 3 actual offers to their clients to ensure customers can make informed choices, particularly around the cost and prices of the loans. There's also opportunity for the Financial Markets Authority to get involved here to help ensure the mortgage advisor channel fulfills its potential to provide suitable advice that promotes price competition and consumer choice. Turning to the last couple of points on the slide, industry and government need to prioritise reducing barriers to housing lending on Māori freehold land. Lenders need to support existing successful models for lending that have been developed, including by explicitly considering the Kāinga Whenua loan scheme. And we want the government to address the unjustified level of scrutiny on Māori land trusts as part of its AML reforms. And finally, industry needs to cooperate to make basic bank accounts more widely available, including work on minimum standards, promoting this among relevant population groups, and ensuring frontline staff are appropriately trained and supported. The Council of Financial Regulators is leading a piece of work on this, and we encourage banks to lean into that and ensure that it is delivered properly. Having a bank account is key for people to be able to participate in the economy. So you can find the full report along with an abridged version and exec summary on the Commerce Commission's website. We have shared this final report with the Minister, and it's now with the government to consider and to determine the steps that will follow. However, I did want to touch briefly on what comes next for the Commission in the context of the report and the 2 other Commission work streams I've previously mentioned, the authorisation for Payments New Zealand and the request to the Minister for a designation of the Interbank Payment Network. The designation is important because it would provide the Commission with regulatory backing to convene a steering group to drive accelerated progress towards open banking. We see this as having broad representation across banks, fintechs, government and consumer groups to ensure we've got a proper roadmap and agreed milestones and a fast track to open banking. If the government agrees to these recommendations, we will convene the steering group within the next 2 months. More broadly, on the recommendations we've directed towards industry, we intend to monitor progress on these and will invite the government to intervene if progress appears slow or stalling. So that brings us to the end of the formal presentation, and I'll hand back to our MC now and open up the floor to any questions.
Thank you. If you wish to ask a question via the webcast, please type your question into the Ask a Question box. Please note, we will only be accepting media questions at this time. We will now pause a moment for questions to register. Once again, to submit your question, please type it into the Ask a Question box. you. Your first question comes from Jenny Ruth from Good Returns and Just the Business. Are mortgage advisors wrong when they say other considerations may be more important than price? If so, why?
Look, what we've heard from consumers is that price really matters when it comes to shopping for a home loan. And so, and our investigation has also showed that often when using the advisor channel, one offer is presented. And so, and we also heard from mortgage advisors that a matching process, they consider a matching process between the borrower and the bank to be one of their primary roles. So, look, we definitely agree that mortgage advisors can add considerable value. What we're asking, though, is that they do more to promote price competition, and we recognise that that requires some investment by the banks as well.
Thank you. Your next question is from Rob Stock from The Post. Did you consider the suggestion that banks should be split up?
We did think about that, but we came to the view that the structure can be changed, the market structure can be changed through the two main levers that we're suggesting. One is a growing Kiwi bank, and the main point about growing Kiwi bank is that it will destabilise the Big Four as it grows. And then secondly, with open banking coming in behind, these are new business models that are not the same as the existing. And I think our view is that that's more disruptive and more enduring disruption and more competitive innovation.
Thank you. Your next question is from Jenny Ruth from Good Returns and Just the Business, who asks, if brokers submit multiple applications and banks have to stop using conversion rates for advisors, won't that add costs that consumers will ultimately pay?
Look, that's a good question. The reason that we're going down this route with mortgage advisors and banks is really driven by the experience in Australia, where things are very different for home loan, for the borrowers, because the structure for the industry is very different. We heard very clearly that it's possible with common data standards and technology platforms for banks to more efficiently consider home loan applications so that their costs of consideration fall, and you can enable better competition as a result. So this is not something that we just invented. We heard about it, we learned about it from the Australian experience.
Thank you. There are no further questions at this time. I'll now hand the conference back to Dr. Small.
Thank you very much. And thanks to everyone who's online. I see there's 240 people here. It's really nice to be able to talk to you this morning. And you've probably heard, we're quite excited about this work. We're looking forward to following through on it. And we're happy to engage and continue to engage with everyone in the sector that we've been working with over the last 14 months. So thank you.